Hello traders, today is going to be a very interesting topic. Today we're going to be talking about counter trading popular and large traders. So if you're in crypto, you very likely have heard about Satto. I don't know if I'm pronouncing that right, but it's the Korean guy who's been trading with tens of millions of dollars every single day live on stream with very high leverage. So there are a lot of things that come with this, but what I want to focus on today is how are ways we can learn from this, and also are there potentially ways we can make money from this by counter trading. First, going said, this video is purely just about profit and making money and losing money. It has nothing to do with the character or even what this guy is like. A lot of traders go through a similar process like this, so let's go look at what it looks like. For those who don't know who he is, I'm going to attach a link in the description of the video, and you'll learn right away. So this guy, Satto, of course, it's all going to be in Korean, but he's been trading for about a year, and he has not really done too well, to say the least. This is just a screenshot of today. You can see that he is currently down $22,000. That's pretty common for him. He has not really had the best track record. Also, you can see on the far right-hand side where it says equity. His account's currently worth $136K, but I think recently he's gone through a few $400,000 losses. I think two $400,000 losses, and then also losses on top of that. So millions of dollars in losses over a year. So in 1 year of live streams and in recorded videos, I actually did all the research before this video just to see, how he's done, and every single account of his has dwindled. So the three that he's shown have been a BTC account, which declined. I think it began around 7 or 8 Bitcoin and it went to 1 point something or less. I think it went to maybe 0. He had a KRW, a Korean won account, that also dwindled very heavily. And then finally, he's been using a Tether account, a USDT Tether account on Bybit derivatives, which has also declined. Why does this happen? What's going on? What can we learn from this? Okay. So basically, high leverage trading is not a good idea, almost ever. There's really no situation ever in the world where you should be trading with leverage, I'd say over like 5 or 10x. It's unless you're hedged, but even then. So here's a little quick math lesson that I find kind of fun and interesting. So this is a probability calculator, and let me explain really what's going on. So his today's short position was a minus 50 or 50 Bitcoin short at the price of 39,950. His liquidation price is 48.82, and currently he's still in the position as of me recording. If I put in 1 day till expiration with the current implied volatility, there is actually a 50.8% chance that he will get liquidated within 1 day. How do I know that? Well, for those who don't know, the probability of touch is a really common probability people use when assessing the risk for liquidations and the risk of a stop loss being hit. The probability of touch is just 2x the lower delta. So if you see the delta screen right there where it says 0.254 and minus 0.746, the smaller those two deltas, multiply it by 2, that's the probability of touch of the exercise price from the underlying price within any time span that you do. So long story short, basically, no pun intended, his short has, if he did absolutely nothing for 24 hours, he has a 51% chance of being liquidated within 1 day. The more days and the longer time that it's active, the higher the chance of liquidation. Of course, the higher the price is, the closer it gets to liquidation, the higher the probability. So this is a really interesting thing that you can do to kind of see that when traders with a lot of leverage take positions like this, it's frankly just idiotic. Because if you run just a quick math assessment, a quick probability assessment of what the probability of them losing their entire account is, a lot of times if they choose to do something like, here's a quick example. Let's say you take a long position at 40K. Your liquidation price is 38K. Price goes down to 39K. You now have a 50, if you just decide to I'm either going to take profit at break even or I'm going to wait till I get liquidated at 38K, right? And you took a position at 40K long. You, at that price, would have a 50% chance, a 50% chance of either being break even or of having your position liquidated. It'd be 50-50 because, equal possibility mathematically of a move 1K up to your break even and a move 1K down to your liquidation price. Even though probability calculators will tell you that there's a slight percentage chance more that price goes up than it falls, but that's because of options pricing. I don't really want to get into that. It's basically 50-50 between two equal price points. Mathematically speaking, with real markets, there are other things that come into play, but this is just a mathematical thing to show you. Do not do this, because if he continues to do this with just waiting till break even or waiting till marginal profit and just keep staying high leverage positions, if you just run a probability of touch to see your chances of getting liquidated, his chances of getting liquidated on every trade are like, I'd say 40 to 50% chance if he holds it for 24 hours. So that's one reason why his account's probably not doing well. Now we get to psychology. Another reason why traders like him tend to fail are these three main things. There are a bunch of psychological biases that I could teach and show you guys about, but I want to focus on these three. Confirmation bias. That's when you isolate one thing, which makes you either bullish or bearish, and then once you become bullish or bearish, you never change. Here's an example. I was watching one of his earlier videos doing research for this presentation, for this video for you guys. And he was talking about how the NASDAQ, the US stock market, was down. Typically, when the US stock market falls, Bitcoin will fall, right? So he shorted Bitcoin. But he just used that one thing, that the NASDAQ was down 0.7%. Because of that, he shorted. That's not good trading. That's isolating one little thing and then making that you're bearish. I mean, it shouldn't be that easy for you to just go from one little thing to, I'm bearish. There should be more steps along the way. And if you are bearish, there are better ways to bet against the market than to high leverage short. I think we all know that. That's confirmation bias. Loss aversion. This is not wanting to take a loss. Psychologists have found, and you can Google this right now if you want, that financial losses hurt 3 times more than financial gain. So the pleasure of gaining $100 is 1/3 the pain of losing $100. That's just how we're hardwired as humans, because we want to keep resources and not lose them. And when we lose resources, they can hurt us a lot more than if we gain the equivalent amount. Let's say like tens of thousands of years ago when we were hunter-gatherers, it would be much worse if you lost all your food than if you doubled your food, right? Because if you lost all your food, you're going to die. If you double your food, you're not going to die right now. You just might die a little bit later. Same with high leverage margin trading. Finally is very common as well, which is very self-explanatory, psychological thing that happens to traders, especially high leverage short term, chasing losses. For him, he lost, I think, hundreds of thousands of dollars, and now every video has been him trying to chase back his losses. This is hard not to do in practice, and I'm totally guilty of all three of these, guys. I have done all three of these multiple times. It happens, but the best step to, I'd say, not doing them is to recognize them and then set up processes where you can't even fall prey to one of these emotions, i.e. trading spot. Chasing losses can occur, if you're down 200K, you just, of your 400K count, you just go all in with the rest of the 200K trying to chase back that loss, not thinking about the mathematical possibility of you losing 200K is very high because of what we talked about before. Especially if your liquidation price is let's say 1% away, which would be, right now $400. If you hold that position for one day, the odds of you getting liquidated are way over 50%. So don't forget that. Now let's talk about the part that you've been waiting for. Again, I am not recommending that anyone goes out and begins to counter trade or do this or do that. What this is going to talk about is using him as an example for what you can do in the future with anyone, with any trader. So a large position trader short-term exploit that I've used, that a lot of other traders have probably used if they're savvy enough, is if he's been using a 240 BTC liquidation price and a stop loss. If price is approaching someone's known 240 BTC stop loss, that offers you a phenomenal risk reward. It's a little bit amoral, but it is a way that you can make money. But let's talk about the risk reward of that. So if you know that, let's say price is $100 away from a large trader's liquidation price, and let's say price is rising, and you know that a large short, maybe Satto, is going to get a 240 BTC short stop liquidation, let's say at the price of $42,000, and let's say price is at 41,900. If you were to buy at 41,900, and let's say do something as simple as like stop loss at 41,800 as price is rising, take profit at like 42,200. And you do that because you think that maybe that 240 BTC short stop loss is just going to buy up a bunch of the order book and price is going to soar because of the buying. This would offer you a risk reward of a $300 gain to a $100 loss, which means that if 25% of the time you hit your take profit instead of your stop loss, then you're going to be profitable in the long run. There are even probably better ways to do this, such as buying 42,900, take profit 42,100 for 200 take profit, and then a stop loss at 42,700 or 41,700. Pardon me. So a 200 stop loss, 200 take profit. And if you're profitable on that trade more than 50% of the time, then long term you're profitable. This is something that you can do because if you know that there's going to be a large sell or a large buy when a certain price is reached, it can be very profitable to try to take advantage of people like that and to try to take advantage of those moments in the market. So I'll show the next slide, but if you look here, this was actually the very second, this is kind of sad, but this is the very second that his infamous 240 long position was liquidated. I mean, had his stop loss hit, so he wouldn't get liquidated. It says 40 right there, but that's because a 200 stop was reached, and then half a second later, the rest of his 40 of his long also got stopped out. So it was a full 240 stop hit, where he lost almost $400,000, unfortunately. Now, what ended up happening is price spiked down the very second that it hit it. I think it was like price spiked down over $100. So it would have offered a really, really good risk reward if one was to try to target the liquidation in the short term, because once that liquidation is reached, it's just a spark to gasoline. It just hits the market hard. Lots of other people's stop losses get hit and just fuels a quick move that allows a take profit to be pretty easy to get hit. Good for us. So that's one thing you can do. It's quite risky, but it is something that if you're morally okay with it, it is a very good risk reward setup. Another thing that everyone has been talking about to do, on Twitter and in YouTube comments that I've seen is just doing the opposite. This can be hit or miss. Let's go over why. So I used to see that he would take trades where he would set a 100 take profit. So just, buy at 43.80, 43.100, take profit at 43.200, hope the price doesn't go below 43.100. That's what he used to do. This is actually a really, really good setup for traders who want good expected value. Why? Well, a few reasons. If you choose to do the exact opposite, put a stop loss 100 higher, and then just wait for the market to go your direction with unlimited profit, here's what would end up happening. When he would do a 100 Bitcoin position long at 43,100, I'm going to put my 43,200, 100 BTC take profit. One thing you could do is put your stop loss directly at his take profit. Because when you do that, you know that there's going to be no slippage because your take profit's definitely, your stop loss is going to hit and it's going to be absorbed by his take profit. That way, you're not really worried about slippage. You're guaranteed to have just a 100 tick loss. So if we short one Bitcoin because he does this at 43,100, put our stop loss at 43,200 where his take profit is, worst comes to worst, we have an $100 loss with that short of one. But as price goes down and he chooses not to take a loss and, his liquidation price is beginning to be approached, this is where you can make a lot of money. Because if you think about it this way, if you take 4 losses of $100 and he takes 4 profits of $100 in futures, and then on the 5th time his take profit isn't hit, and then price goes down $1,000 and liquidates him, you would have lost 400, a little over, because of your stop loss getting hit 4 times with 100 ticks of a short of 1. But then when it falls 1,000, you make 1K. And your net would be 600. So this is something you can do just leveraging, loss aversion of other traders and looking for easy dopamine hits for him and doing the opposite. Final thing is the easiest thing to do, but not really something I'd recommend. Ugh. But small position counter trading. This is when you could use 5x leverage and just taking the exact opposite of every single action he takes, no matter what. No matter the setup, no matter what, just take the exact opposite. I prefer method 2, where it's more controlled, where he has to take profit at a certain price. We have a stop loss at the same price, so we know exactly what's going to happen. We're either going to hit a stop loss or get a massive profit as he gets liquidated. The final thing is just more, hit or miss, because if you do this just once, he could have a very good trade and then you could be screwed because you're doing the opposite, which means you're going to have a very bad trade. But a lot of the time he has losing trades. So that can be a good thing to take advantage of. And if you look in the past year of every single account that's dwindled, as his USDT account has dwindled too, if you had done the exact opposite action, even accounting for fees, you would be up a boatload of money. So that's going to do it for this video. This has nothing to do with Satto, because there are a lot of other people out there, some of them who will live stream large accounts, some of them where you're going to see data of what large traders are doing. Again, this has nothing to do with him. This just has to do with making money from large traders and making money from traders who might not really know what they're doing and are kind of just gambling with high leverage and high amounts of capital. If you can avoid, the dopamine hit of just taking easy wins and focus more on great expected value, then, counter trading guys like this is a phenomenal risk reward, especially in the long run, because a lot of traders, as you know, have their accounts hit zero, especially the ones who use very high leverage and chase losses. And if you begin to think like a market maker or like a hedge fund trader or an institutional trader doing the opposite, then there could be a lot of alpha in there. So that's going to do it for this video. I know a little bit controversial. Satto, I really think personally for you that this is really bold of you. And I really respect it, actually. Even though a lot of ways we can make money off of you, I really respect what you're doing. I think that a lot of traders just don't have the, cojones to do what you're doing. So massive respect. And I will continue watching your live streams for business and pleasure. With that, happy trading. Be careful when you counter trade. Be careful who you're counter trading. And keep risk management in check. Have a strategy. And be okay with loss. And don't be too happy with gain. With that, I'll see you guys in the next one.